I'd like to introduce you to a couple of other elements in taxation. We're going to start by looking at goods and services taxation. Before we do that, I just want to mention that income tax itself is often something which is taken for granted as part of the air we breathe, especially in the finance and investment world. But one of the curiosities that while it's highly accepted, I just want to remind everybody that income tax was originally suggested, promoted by Karl Marx, the father of communism. And so while we seem to accept it in our free market economy, it's not necessarily a healthy form of tax or a useful one. And while theoretically it might be equitable, in practice it's complicated by so many different provisions and complications and whatnot that it tends not to achieve the kind of social goals which old Karl Marx advocated. And really it causes a number of economic problems or disincentives. When we moved to GST, which was originally argued to be a simpler tax to overcome the problems of avoidance with income tax, we find that instead of solving the problem, it actually has made things considerably worse. The goods and services tax is a form of indirect tax or a consumption tax. It's levied on what people spend, not what they earn. And so income tax is a tax on earnings. The consumption tax, a GST, is what people spend. Somebody could say, well, what's the difference? Does it really matter whether I'm being taxed as money is coming into my pocket, which is income tax, or when it goes out of my pocket when I'm consuming? It doesn't really matter. The curious thing is that GST is problematic in terms of the reality of its ability to be fair. It was originally argued, especially by particular political orientations, to be fairer because it was perceived that there were a number of people escaping from the net of income tax, and so they weren't playing fair, especially people on the higher income end of the income spectrum. However, when we look at GST, it tends to be regressive. Now that's a little bit peculiar because you'd think, why is it that a consumption tax would be regressive? Why is it that it takes more of the tax burden out of the lower income part of the community than in the higher income part of the community? And the reason for that is that investment spending, or investment, is a form of payment, if you like, which is not consumption. And so when we have a consumption tax, it might tax how much money I spend on petrol or buying a new set of clothes or what have you. But if I'm sufficiently wealthy that I only spend a relatively small part of my income on consumption, then that part that I don't spend on consumption is effectively tax-free. And so if you are on a high income, and by high income we'd be thinking of, let's say, over $200,000 a year in the present situation, GST becomes quite attractive because by the time you get to that point, you'll be using a lot of your income not for consumption at all, and that means not for tax. The other aspect of the GST was that it was intended to be simple. A one-size-fits-all, it applies to everything, and that was nice in theory, but unfortunately we find that there are so many exceptions, and I've listed a few of them here. But one of the things which is a bit curious for the real estate world is that real estate is affected by GST in a most complex way, and so it becomes quite a study in itself, which is beyond the scope of what we can cover here. It needs to be remembered that the idea of GST is that it's intended to capture the increase in value. Let's look at an example of that. If you have an example here of a sale where the apparent revenue is $110 on something which otherwise would have cost $100, the consumer is actually paying $10 in tax. From their point of view, they're simply paying a price which is 10% higher. The merchant must then deduct the GST paid may deduct their factor costs, the GST sort of paid on their factor costs. The way that works is that if the item which is going to be sold for $100 cost the merchant $77, on which the merchant is going to charge the $10 worth of GST, the merchant may deduct the GST which is included in their costs. In this case, if an item costs them $77 GST inclusive, it means it really costs $70 plus $7 in tax. The merchant may say, well, I have to pay $10 in GST to the government. However, I've already paid $7 in the GST that was on my cost of goods, and so the actual amount of tax that the merchant needs to pay is $3. And so the merchant is really paying a form of income or value added taxation. And that kind of works all the way back through the supply chain. I won't go too far into that. It's really an accounting issue. But if you like, that just gives us, if you like, the backdrop to how that works. In the construction industry, this is important because it means if I'm building a house, for instance, I get to, if I have to pay GST on the new house, or GST is applicable to the new house, then you get this input credit for the GST which has been paid on the factors, which are largely the building materials and so on. That ignores the value of the land, which often is the most important component in a new property. And this is where there is a particular strategy which the ATO will permit, which effectively takes account of the land value. And I'll let you look at that in your own time from the ATO website. GST on property tends to be applicable for non-residential leases and on new development sales. That's new residential stock coming onto the market. And that's the residential developer has to take careful account of GST, and especially this area of complication where the land value that the developer is working with doesn't come with a GST component built into it. And so the ATO, to make that a little bit fairer, has developed what's known as the margin scheme. A little bit complicated to go into. If you are working in development and do need to understand the margin scheme, I recommend that you go to the ATO. Basically works the same as the previous slide, but it has some special provisions specific for the development industry. From a practical point of view, we can say that GST is charged on all non-residential property rents, and so it becomes a 10% excise, a levy if you like, that is separate to the rent. GST is also paid on the rental expenses that are deductible, and therefore you end up with a factor cost deduction. Strictly speaking, it is not part of the investor's cash flow, and likewise it's not strictly speaking a part of a merchant's cash flow either. GST really is a tax which the merchant or the property investor collects on behalf of the government and then sort of pays off to them. If you're putting GST into a DCF model, modelling a property investment, it's easiest to consider your expenses GST inclusive for expenses related to residential property. Basically just grosses them up to the actual cash amounts. However, you'd use GST exclusive expenses for non-residential property because GST is applicable in that case, and that way you're able to quarantine off the GST layer of costs and revenues and so on. GST for development may include the margin scheme. As I say, it's a fairly specialist area. It's worth reading up on that if you are dealing in it. It's a specific area, or get specialist advice. And as I say, the rates and taxes are treated a little bit differently because they're not considered as input credits. They're not considered as general expenses. And so you need to be a little bit careful of that. Again, if you're working in this area, get the services of an accountant who is competent in working with GST obligations. The example here that we're going to work through is fairly static. Basically, the rent in a residential property, you don't normally think of it as GST inclusive or exclusive. It simply is whatever is negotiated. The expenses cash flow is GST inclusive, so that's kind of fairly straightforward. For non-residential property, modelling may use accounting earnings, and then GST is accounted separately, and that's probably the tidiest way of running it. Different people may have different preferences. For non-residential property, it's possible to follow the precise cash flows, and so a quarterly GST return makes the cash flow difference quite negligible. The actual economic impact for residential property is perhaps overestimated, but you'd really have to look at particular cases, and certainly doing your modelling rigorously is the best way to check whether it's worth taking into account or not. And there we just lay out the assumptions that are built into the modelling that we're doing. In the PowerPoint presentation, I'm including some additional notes in the presentation. I don't know if it's necessary to go through them for brevity. If the demonstration leaves you a little bit in the dark, then you're most welcome to come back and look at this example. It basically breaks up the way that depreciation calculations are done into more detail, and so hopefully that will make it a little bit easier for you to follow. Hopefully with this and some reading from the ATO, you should now have sufficient understanding of the way that tax is taken into account with property investment modelling. And as I say, at the end of the day, more information, and especially getting the opinion of a tax specialist for specific cases, is ultimately always necessary.